All right. Hello and welcome to the Man of Legacy podcast. This is episode 17. I'm your host, Coach Dennis from manoflegacy.org and mentoring.men. Here we talk about men, women, family, sex, masculinity, and life in general. If you haven't done so already, please hit the subscribe button so you'll be notified when podcasts as well as other videos are dropped. Today, joining me is Rob Schneps, senior partner from Curry Schneps, LLP. And Robert's an attorney whose practice is estate planning, trust administration, and tax issues. And to say he has some knowledge in tax issues is an understatement. You've been in the workforce now for 35 years. You went to Hofstra. You've got your law degree there. And then you did go to work for the evil empire, the IRS. But you left them and went into private practice. So we always look at that as a positive thing. But that had to be just almost like another degree, you know?
Yeah. It was an interesting few years. I didn't stay too long.
So today, I want to have a discussion about wills, life insurance, and estate planning. Yep. And so a lot of people think discussions about wills, life insurance, and estate planning is boring. And it's kind of funny because it's critical. Quite honestly, you know, if you have kids, you need to address these things. If you have assets, it really, as we were talking before we started recording, everyone needs a will, don't they?
Yes, absolutely.
Yeah. And I would have said no assets, single, probably no need for a will. Why would you tell me otherwise?
Well, it may be that you think you don't have anything, but everybody, as an old lawyer said to me when I first started doing this, everybody has a watch, at least, right?
Yeah.
But of course, there's more than that. Some people have hobbies. They've got collections of different kinds of things. People will fight over that stuff if it's not clearly, earmarked to be received. In addition, you may not think you have an asset, but I was involved with a situation a number of years ago where the decedent, as we call it, died because he was hit by a county bus. And so he had a lawsuit, but he couldn't bring it because he was dead. So the only one who could bring that is a fiduciary of his estate. A wife can't bring it. A sibling can't bring that lawsuit. It must be the fiduciary, meaning an executor or an administrator, would have to bring that lawsuit. And this fellow collected several hundred, or his estate did, several $100,000. If there's no will, then it'll pass by intestacy, right? Which in each state has its own intestacy laws, depending upon who your next of kin might be. But then usually, for example, here in New York, and I am a New York lawyer, so I just want to say that I'm familiar with New York law, not giving legal advice here, but each state would have to be checked. But here in New York, the administrator would have to post a bond, and that could be several $1,000s that have to be paid over a few years. And so a will can avoid that kind of an expense.
That's a good point. I never thought about it. As you're talking about collections, my brother-in-law is a bass fisherman. Yeah, he's got a boat, and you think, oh, the boat's what's the asset. His fishing rods are worth thousands of dollars, his rods and reels. What he spent on a couple of them is mind-blowing.
Yeah.
But he fishes all the time, and he's retired, so it's great. And that's a great point. I would have said, you're saying I never thought about how you go could change things. You could be broke and have not a single asset, but suddenly, because of your death, you're worth hundreds of thousands or millions of dollars.
Right. Right.
And
there are certain, even if you don't have, even if a man doesn't have all that much, I always tell clients that there are certain documents that every adult should have. And that is a will, or some document that disposes of your property upon death.
Mhm.
That can be done in a trust, that can be done through a will. Typically, we think of it as a will. But there are other documents in addition to that, what we would call advance directives. And these are documents that you sign while you're alive. They're of no use after you die, but they are useful in the event of incapacity. And those are financial and healthcare kinds of documents. And we can talk about those. But the fact of the matter is, just because you're married or you have adult siblings, that doesn't mean that legally they can handle your assets for you. It also doesn't necessarily mean, again, state law, that they can make healthcare decisions for you. Here in New York, we do a document called a healthcare proxy. And in that document, you can appoint people to make decisions for you if you don't have capacity. If the doctor has said he can't decide these things anymore, that person can act.
You know, I'd forgotten all about that when my dad went into the nursing home. My sister was the first and I was the second on the healthcare proxy. I had to sign some paperwork. And my dad was very clear. He had a DNR. And I got to know the care providers. And, you know, I was very clear. Because he had Alzheimer's and he was ready to go, but his body did not let him. And I told him, I said, yeah, the worst thing you could ever do is something and violate his DNR. And then he's still here when he's ready to go. And I said, that would actually upset me because it was against his wishes. And, you know, one of the things I've always looked at, you know, especially once you have kids, you have to really take care of these things. I forgot about the advanced directives, you know, and that's something I'm actually lacking and I'm going to need to give some thought to and have that taken care of.
Yeah, very important. You know, without them and with no one legally that can make decisions, including financial decisions. Let's say the family, you become incapacitated and the family home has to be sold or mortgaged. Who can sign those documents for you? Without the power of attorney, that's what we call it here in New York, no one can do it. So what happens is we tell the family, now we have to go to court and have a guardian appointed. And that is a very expensive proposition. Thousands of dollars to have some where you can, for a few $100s, you can sign the necessary documents. And there are courts here in New York when someone comes in and says, I want to be dad's guardian. And they say, well, he's got a healthcare proxy and a living will. He's got a power of attorney. What else is that you need? And the answer is really nothing.
I like that. And so I made a note. I'm going to have to address that.
Definitely.
That's also going to involve a conversation with my son. You know, and these are conversations we need to have with our parents, depending on their age.
Certainly. Certainly.
You know, if you've got parents that are in their 50s, 60s, 70s, you need to have the conversation. Are all of your affairs in order? What are your wishes? And it's not that you know, we're all going to die. So, I mean, let's not kid ourselves. We don't know when. It would be wonderful if we were given a date and a time, but that's not how life works. And I don't think anybody consciously wants to leave a mess for their children, but they don't think about the consequences of things. And I'm aware of some ugly battles because people have died without a will. And it tears families apart when there was no need for it.
Absolutely. Very important, really important.
If there's minor children and both parents die at once in a car accident, what are some of the problems that could be associated with not having a will, things along those lines that you've seen?
Well, as I had kind of alluded to before, if one dies without a will here in New York, then the property passes by intestacy. So if there are children, and typically they would be next in line if your spouse is deceased, If they're minor children, though, they can't receive property. They can't receive property outright. Here, it's 18, believe it or not. In New York, you're considered an adult when you're 18. Now, I have children, and I can tell you it's a form of inflation. As time goes on, the age at which I believe a person is mature seems to go up, like the prices, by the prices of eggs. So, so that's for certain. And so what happens then is that their property has to be held in guardianship accounts, which is again a very expensive proposition if the funds are going to be invested. Bonds have to be filed, et cetera. And if it's just going to sit in a bank account, well, there's still the court that's involved with everything that goes on. Not to mention who's going to actually be the surrogate parent. Think about that.
I personally would not want the government involved in who's raising my kids.
Right. Now, I was involved many, many years ago with one of the few times in my life I saw a simultaneous death where a husband and wife were killed on a parkway here on Long Island, and the death certificate showed they died 20 minutes apart, and they had minor children, and it was years of work that had to be done and taken care of, where if they had wills, it would have been much more efficient, much less expensive. So once a child is in the picture, it's a whole different ballgame, and everything has to be covered, including what does it cost to raise a child? You probably have statistics on that.
I think the number now is somewhere between $250,000 and $300,000 from birth to getting them out of the house.
Yeah, and does that include college? It depends on what college and all of that. And most of us want the best opportunities for our children, and I know you've done videos on the need for life insurance, and there's no greater need than when a young man has children, newborn children, because someone, and you also point out that both spouses, both parents should have life insurance. Because if the man, for example, if it's culturally the usual way, if the man is out there working, the wife is part-time, or she's taking care of the children, or whatever it may be, I hate to sound sexist, but there's going to be a cost associated with the care of the children at that point if mom's no longer around.
Yeah.
And there is no cheaper way to create an estate than getting term insurance when you're in your 30s.
I love that you said term insurance. It is the most affordable and easiest to obtain. Avoid anything that is, I'm a Dave Ramsey guy. I went through Dave Ramsey. I even taught the course, Financial Peace. Avoid whole life, universal life, all that. Get term insurance. And Dave Ramsey always recommended 10 times your income. And I've always told people, if you have a stay-at-home mom, you're going to hire Mary Poppins, depending on the age of the kids. You might need a nanny. And so you have to have enough life insurance that investor can generate the income to pay for that, plus have money aside for college. And also, you're still looking at a minimum $500,000 to $1 million on the stay-at-home parent, whether it's mom or dad. And, a good rule of thumb is make sure you're adequately insured, and you can always add a 20-year policy with every kid that's born. It is so inexpensive.
Yeah.
If you don't have, and so you talked about in your 30s, in your 20s or 30s, if you have children and you get life insurance, it is pennies.
Yeah.
And then you do that when you're young and healthy. You don't run the risk of becoming uninsurable because you have health issues that come up later in life. And I personally, in my family, my younger sister got married, they had a child. Neither of them had life insurance. And then my ex-brother-in-law came down with ALS, which is a horrible disease. And he ultimately passed from that. And I know I talked to her about it. She still didn't get life insurance, and she ended up getting lung cancer and passing away from that. And it's like, what is wrong with, and I told them when they had kids, but again, we never think we're going to die. I just turned 58. I plan on being here for another 25 plus years. I don't know if that's the case or not,
Nobody does. Right, absolutely. Now, interesting that, just getting the life insurance, well, very important. Very, right, we've gone through it, very important. But it is important also to coordinate that with where that life insurance is going to go. Where's it going to get paid? Again, if you have children, minor children, they cannot receive, they're not, the insurance companies will not pay it to a minor child. They will tell you, go get, tell somebody, go and get a guardianship established for the benefit of this child. And then we're back to all of that stuff again. So to have a will, you'd want to make sure that the will dovetails with the insurance. This is what I mean. Let's say you're a married guy and you buy $500,000 of life insurance. You will have a primary beneficiary. Now, typically that will be the spouse. That will be your wife. If you die, the insurance will get paid to her and she'll have those funds to pay for their lifestyle, et cetera, et cetera. If she were to predecease you, like 20 minutes before you, like the accident that I mentioned before, now it's going to be payable to the children. Well, if the children are minors, your will has to provide that a trust will be established for the minor. And so that way there'll be an adult that you can appoint to receive the money, put it in the bank, and then use it for their benefit pursuant to the terms of the trust until they reach a certain age. Now, I do not recommend to anyone that 18 be the age. My son is 38, and people have told me he's a very smart kid. I'll take their word for it. But I'm the one who gets to see him playing video games sometimes when I go to visit him. So I'm like, and that's a great pastime, but I just want to say that, it's much later age by which I would trust a child with any real money.
I
on
like
the
that.
child's own. And
And-
so I recommend to clients that don't give the money outright. The money's always available through the trustee. The trustee can use it to pay for monthly expenses, for rent, for college, and those kinds of things.
For a car.
For a car, those kinds of things. But until the child reaches a certain age, and you don't know what kind of child you're going to have. I had a situation years ago where a fellow died intestate. His son was 19, and there were many hundreds of thousands of dollars which would be payable to this child. This child had a pronounced drug problem. And the mother of that child said to me, we have to do something because he'll kill himself with this money. And we were able to persuade him to get the money and immediately put it into a trust that he established and have his mother be the trustee. And so there's all kinds of reasons why it's important to have a trust that goes beyond the age of 18.
It's interesting you brought that up because I hadn't even thought about it. I have a friend whose brother had passed away and he had 2 sons. And they ended up getting all of this money at a very early age. They were under 20, but basically they ended up, I think one might have been underage upon death, but then soon enough became, and the one bought a house. And he was already engaged, used it the way we would as a dad be like, good job. The other one had a really nice car and there's not a lot of that money left. And I have seen and talked with other men who they've done what you said, we're going to take care of them. And then they stair step when the money comes, an amount at 25, an amount at 30, an amount at 35. which is another way to bless your children, because you are correct. I know I matured significantly in the last decade. But even at 25, 26, I think, we see a lot of failure to launch, or it isn't even a negative. It's just they haven't found their path yet. And what they would do with that money, they're going to regret it 10 years later if they get it too soon when they look back.
Right. And you don't know, I mean, it doesn't have to be something as that, difficult, or as let's say there's a nice thing that happens, right? The 22-year-old gets married. And now he's got $500,000 sitting in his bank account, and he and his wife are both working, and they pool all their money, and everything they earn, and they're lying in bed together one night, and she says, everything we have is joint. Why is that money over there? Why not? It should be joint. Everything. That's how we do things. And he says, okay. And he takes the money and he puts it in an I love you account. And then 6 months later, they go to divorce court. And you know what they found out? They have commingled the funds.
It is a marital asset now.
And she's now making a claim. Or at least her lawyer is. So, yeah. I mean, there's lots of reasons why, and this may be something that a man is sitting there listening to this and thinking, gee, what are my parents doing? Are they leaving their, whatever they might be leaving to me? And I know it's a difficult conversation to have sometimes, because somebody, whether it's the child, is going to be thinking, they're just going to think I'm interested in their money, and I'm not, so it is not an easy thing to do.
My dad was in his 80s when he passed. In his 70s, he still had life insurance because he'd gotten some policies way back when, and they were paid in full, or they were such a small amount. And we had this conversation. He goes, I'll never pay into them even a fraction of what they'll pay out. And I was arguing that was stupid, because he was self-insured. The house was sold after mom passed. He didn't need this. The kids are on their own. And now, what I never thought was that I was one of 3 beneficiaries. I never crossed my mind that, because all the life insurance and everything he had was divided by 3. And when he did pass, I was like, what's this? Oh, there's life insurance here. There's this little policies, but they added up.
Yeah.
And, I will put a playlist at the end of this video to a financial series. If you get an inheritance, out of respect for the person who left it, keep that in a separate account. I even recommend a separate bank. Never commingle those funds. I don't care if you're the husband or the wife, because exactly what you said, Rob, you put that into a joint account. It is now it's going to be a marital asset more times than not.
And how much easier is it if you're able to turn to your wife while you're lying in bed and say, honey, there's nothing I'd want more than to put that money in both of our names. But they left it in a trust. And, Uncle Harry controls it. I can't do that. So, so it takes that pressure off.
Yes.
And just back to life insurance, I'm not an expert in, but life insurance is one of those things that it's got all kinds of uses. It's not, I mean, term is what we usually think of and recommend. Yeah. But there are policies, there are benefits to cash value in policies. I'm not recommending it, but they can grow on a tax deferred basis. The growth in them. They're not subject to creditors in New York. So, I mean, there are, so if a guy is out there and he's thinking of some kind of permanent insurance for whatever his reasons, that's something to keep in mind.
And there are certain situations, there's always that, this is why you have a team to help you with a lot of these decisions. There may be times, because of the way it's situated, you're putting money into something that the way it's packaged is very beneficial for you, as opposed to your normal John and Abby who've got some kids and both are working somewhere that don't have significant sums of money.
Right.
And you hit on a really key point. You can't leave life insurance to the kids. So when I got divorced all those years ago when they were little kids, we put in the divorce decree we were going to have to carry X amount of life insurance. The intent was to make sure the kids are taken care of. And that policy lapsed here a couple of years ago. I ran the term out, never got to use it. So I was glad about that, or my estate didn't. And I was blessed with my ex was good with money. And I've had people go, well, who's the beneficiary? I said, she is. They're like, I would never leave that to, and again, this is where we're talking about the trust being formed and working all of this together. I was very fortunate. My ex is a good woman, would have spent every dime of that money on the kids, no doubt. Not everyone has that situation. Hence, you could then have a trust created, and you can put very specific guidelines in the trust and how the money's to be used, can't you?
Absolutely, absolutely. Years ago, I I did a trust for a couple in Manhattan, and they lived in a beautiful building apartment. You know how Manhattan can be.
Yes.
And they specifically wanted to make sure that their daughter would live in a building with a doorman, and they wanted that in the document. So that's pretty specific. I mean, that was
yeah,
that was
and they were used to a certain style of living, and those are, that's a thing back in New York.
yes, but there's also when I draft those kinds of trusts, I also put in there language that says, look, it's not my intention that my son become a trust fund baby.
Mm-hmm.
I expect that these funds will be used when they're young for their education to lead to a productive life, however they come to define it. But I want to remember to discuss, there are certain things that become big assets, right? Life insurance is one we can acquire. But I also want to make sure that we discuss, at least touch upon, retirement funds. Because there are, people have jobs these days and they have 401ks and matching and all the things that go on. And those monies, in case something happens to one or both parents, they're going to get paid they're going to get paid out at that point, or at least paid in a way where it stays in some kind of a deferred plan. So, but if both parents go, and it's then going to be going to the children, once again, it can't be paid to minor children. And so it should go to a trust. And then getting back to the what age,
Mm-hmm.
a kid who inherits $100,000 in a bank account, let's say a 20-year-old, and he blows $100,000. But if that same kid blows $100,000 from his parents' IRA, not only does he blow the 100,000, but now he owes Uncle Sam income tax on the 100,000.
Yes.
And now that's going to follow him forever.
That's a great point. So I was in the Army from active duty from age 19 to 22. And then I went National Guard, but I was looking at re-enlisting. And this is the mind of a 22-year-old. And I was looking at something with a very nice re-enlistment bonus. And my thought process was, what car could I buy with that?
Exactly.
Not, and I don't know if Roths existed back then. Nothing about thinking about the future where 5,000 at age 22 put into a Roth, and then doing that for a couple of years instead of buying a car since I already had one. And I think that was an area I overlooked when my kids were minors, because I did have them as the beneficiaries in my retirement stuff after the divorce. Never even thought about that.
Yeah.
The other thing for anyone who has gone through a divorce, make sure you've updated your beneficiaries. There is nothing worse than meaning to leave things to your children if you've had an ugly divorce and an ex is still listed as a beneficiary, both on the life insurance at work and the retirement accounts.
Certainly.
The retirement accounts and life insurance beneficiaries need to be updated when life statuses change, and marital statuses especially. It's something we don't think about. And again, there are people who are, and women out there that, know what the intent was and will do the right thing. But when you get into large sums of money, you want it spelled out and you want your paperwork in order. So we eliminate wasteful arguments and your will gets done. And honestly, that's what it comes down to with wills and estate planning is, what do you want to do with and what do you want to leave? And I have a very specific list of items that matter to me. My son hasn't even thought about it, but that jersey on the wall behind me is licensed and autographed and certified and authenticated and is worth, I could buy a used car for what that thing is worth at this point. And someday it may be worth a lot more based on hopefully some positives in the next 10 years. But, there's things like that. And it took quite a bit of thinking to go, what are the things that truly matter that I own? The computer doesn't matter, but keepsakes, family things, heirlooms, and to go through and to list those out.
Yeah.
And
absolutely. And the documents, I tell this to people, and it's, we have relationships, personal, business. There are probably men in the community who are out there, either have their own companies, do business, and they do business certain ways. They conduct their personal lives a certain way. But when someone's gone, the landscape changes. And and the family finds itself all of a sudden in the world of life insurance companies and all their rules and regulations, and courts, and then what a guy had in mind, or what handshake agreement he had with somebody, or any of that other stuff becomes meaningless. Or they opened up an account and they didn't realize it was joint. It was just, I just wanted them to have access to money, and then the person who receives it says, well, this is mine now. It's, and so many things. And there's a reason why there are thousands and thousands of cases that come up, but it never happens to us.
Oh, it's not going to happen to me. I was very fortunate. My sister was handling dad's money, the good sister.
Yeah.
And she always did right. And we had a conversation about him outliving his money, because we were there was a legit, he was in an Alzheimer's long-term care home. And so when he did pass, I didn't think, I had no idea. I never asked her how much. It didn't matter. When it runs out, she's going to come to, we're going to have some tough, I'm going to have some tough budgeting things to address, but I'm going to do what I need to do for my dad. And all I will say is I thought, oh, there's probably X left. Yeah, I had no clue. Maybe I'll get $5,000. And it was a multiple of that. Now, not what I consider significant money, but it caught me, it was $50,000. It caught me off guard. I was like, there was that much left? Oh, okay. And I thought, how can I honor dad? And with some other, and I was sitting on it trying to figure that out when some of this life insurance stuff came through. And I was like, Dad, you're a knucklehead. You didn't need this. And I'm like, I'm glad you didn't cancel it. Listen to me, because that's how I paid off my house. I took some other money I had and some other investments. I realized, wait, I can get my house paid off, because I was when I bought it, I purposely didn't buy larger than I needed. And it was a way to honor him. And I was like, once I figured out I could liquidate a few things and I would ultimately be able to do that, I was like, it was a no-brainer because I don't need stuff. And I thought that was a great way to honor him. And, it was mind-boggling when I was able to do that, in my early 50s, because I had a plan to have the house paid for by about 62, being aggressive with paying extra. And yeah, so I have to get the advanced directives taken care of. I don't have that. And then obviously, because one of the things I've done is I've had my girlfriend's a living girlfriend now. And I don't, I had a friend come to me. Girlfriends realize that when he dies, the estate, the kids, they're going to sell the house. She's going to be homeless. And he's like, how do I address? We had a conversation. He's like, you're the only one I can talk to about this. My buddies don't know. And I said, well, all I can tell you is what I know from what I've seen. And he used life insurance. He got a term policy of X amount because what he wanted was to take care of her. And he was able to do that. And and he has the same thing. I'm like, well, who do you want to get the house? And his retirement is significant. He's been where he's at a long time and he's done a great job. And so it has grown nicely. And so it's one of those things. And I had last night, we were discussing during poker night, prenups and wills and estates. It came up. One of the guys got engaged and I said, oh yeah, you need to prenup. He has a business. And he's like, and I said, you've done a video. He's like, would you send me that video series? And then another guy goes, could you send me that too? Because they haven't thought about it from the estate planning side. And, you mentioned it earlier, we're not giving legal advice. It is state dependent, all of these laws. You need to find an estate attorney in your area, and better to spend 500 or 1,000. And if you have to spend 5 or 10,000 because your estate is so huge, good for you. That's a great problem to have.
Absolutely.
But for most folks, you're talking a small amount of money that is the most loving thing you can do for your loved ones. Get the life insurance you need on both you and your partner, get a will drawn up, and get the estate planning aspect and trusts if the kids are young and all of that taken care of so that you can love them even when you're gone.
Absolutely. And it's not something you have to think about every day, every week, every month, not necessarily even every year, but certainly when things change. But not just things in life. Like, for example, you get it all set up and you have $100,000 IRA at the bank, and you set it up with beneficiary designations with the bank and all, and it's set up properly, coordinated with your will.
Mm-hmm.
And a year later, you go to a different bank and you change your IRA over, and they say, oh, you're beneficiaries, and you just slap down your wife's name and your kid's name, and you forget that you wanted to make sure that you have a trust for your kids and that you want to have the beneficiary designation consistent with what you had. You just went to a different institution, right? And you'll be surprised how many people they don't follow through and continue it, or make that call and ask your lawyer or accountant or someone, and it's worth the call.
And it only takes a few minutes. I was fortunate enough to work directly for corporate counsel at my last employer before becoming self-employed. And sometimes that little one sentence, she was like, 2 words can change the entire meaning from a legal standpoint.
Oh.
She was like, it was like every time I wrote a written program, it was like going to the English professor. Because she's like, no, we need to change it this way. But it's true. And if you have a change in status, you need to update these things, guys. And as everything's rolling along, you could conceivably, if nothing changes and you stay at the same employer and you're happily married, you may go 10 years and not need to update anything, but it's something to periodically give a thought to. Don't forget it exists. I know that I've got some work to do and some updating to do. And then if I have a status change down the road, again, another updating, changing, how do I want to handle things? I talk, you're with men in the community about being intentional, living an intentional life. And that includes being intentional with passing, and that your will be done and that you take care of your loved ones. I want to thank you for taking your time out to record this, because it is not sexy. It's not a snappy headline like some of my videos, but it is so important that men take care of this to take care of their families. And I'm hoping, and I have personally known from when I taught financial peace, a family that went and got life insurance, and then one of them did pass. And that saved them, because these things do happen. And I do know, you talked about we talked about it happens even with young people. I know of somebody who was in their mid to late 20s, had a 1-year-old. They were having their first weekend getaway since the baby was born. And he was getting a little impatient because she was still upstairs. She had some sort of aneurysm and had passed in the closet in the master bedroom. Perfectly healthy that anybody knew, and was about 26. So these things do happen. So we've got to make sure we take care of them, so that if tragedy does strike, that everyone's taken care of.
Absolutely. Well, it's been a pleasure to sit with you and talk about these things. If there are any questions, I'm happy to, post this. I've been happy to, help if I can.
Yep. Do you only do New York, or do you do Jersey also?
I only do New York.
Okay.
But
I will put a
have
link to your
Sure.
Your firm in the notes down below, and that way anyone in New York who's needs some help with this is the man who can do it. You've only been doing it 35 years?
Yeah, something like that. I don't like
Yeah.
to think about it too much. Yeah, and if somebody's in another state, I have colleagues that I'm in touch with and have access to, and can make a recommendation to someone if you need that kind of thing, and I'm happy to do that.
Perfect. All right, Rob, thanks a lot. You have a great day.
You too. Thanks again. Bye.
Bye.